Welcome to the Hey Docs podcast with your host, Jill Allen. Today, I am welcoming back Matthew Kroeker, SVP and Regional Business Development Officer at Bank of America. Matt works closely with orthodontists at every stage of practice ownership, from preparing financially while still in school to deciding between a startup or purchasing an existing practice. Matt brings a clear lender side perspective on what banks are actually looking for. In this episode, we're breaking down how doctors can set themselves up for success, understand today's lending environment, and make informed decisions as practice costs continue to rise. So let's get started. This episode was brought to you by Gray Finch. Hey docs, if you want to have a great business, the right practice management software is essential. But some can be slow, outdated, and lacking good support. That's why I recommend Gray Finch to all orthodontists. It's the fastest, most reliable, and most secure platform to grow your business and improve your efficiency. It's completely web-based, so you can run your entire practice anywhere and from any device with no servers, no downloads, or hidden fees. They even have the most helpful and responsive support team around. Right now, Gray Finch is giving a $500 discount to our listeners. Visit grayfinch.com/Jill Allen to learn more and see why it's one of the fastest growing providers in America. Matt, I am so excited to have you back on Hey Docs. Thanks for being here.
I'm excited to be here. Thanks for having me.
Yes, these are always some of my favorite episodes when we get to connect, talk about things that you and I are both very interested in, and the kind of getting the pulse on where our financial industry is at right now and what the banks are doing. I'm super excited to talk about that today.
Awesome.
But in the event that somebody does not know who you are or has not listened to one of our podcasts together before, would you mind just sharing a little bit about yourself, a little bit about your role at Bank of America, and just anything and everything that you want to share about you?
Yeah, no, that's awesome. No, thanks for having me. I work for Bank of America. We're a healthcare lender. We're celebrating our 30th year of our practice group this year, which is so exciting, so awesome. I'm half of that. So this year will be my 15th year with the bank, which is great. Wow. It's a good place to be. They've treated me very well and we treat clients well. So it's been good. I live out in Colorado with you, my entire job is focused on covering dentists and orthodontists, start, buy, or grow their practice across the country. Live it, breathe it, for better or for worse, just trying to give people what they need to help them realize their dream. Because it's not for everybody, but for the ones that do, it's really cool. And there's a lot of education along with it, which you think of a banker and it's okay, it's just somebody trying to get you to do something with them. But like my job, I feel is truly, it's 75% education on, hey, here's what you can expect and here's what you need to do to be prepared. And I know we'll talk through some of that. Yeah, happy to be here, excited, and thanks again.
Yeah, absolutely. I thought when I was like, okay, we need to get Matt on again. And what do we want to talk about? And I think what I would really like for us to jump into is just, can you give us a pulse on where you think we're at, where you think lending is going as we're heading into 2026? And then I want to jump specifically into early associates and residents and whatnot. But I'd love for you just to give us, since we're top of the year, give us, where are things going? How are you guys feeling?
Yeah, I think we're in a really good spot. And 12 months ago, there was a lot of unknowns. Interest rates haven't done a ton. There's a lot of noise on the Fed dropping interest rates. At the end of the day, that does impact our dentists some, but most of our loans that they'll see are fixed rate, and those have been fairly steady. They've gone down actually a little bit, but there's not as much volatility in the market. So I'm hearing a lot less of the people, of our doctors, not really sure what they want to do, and a lot more people diving in, which is exciting. And I think from a lending perspective, we've increased our loan amounts, we've increased our startup amounts, and that's all due to the performance that we have. We have a ton of clients on our books and we're monitoring that to make sure that, hey, do we understand what we're putting our doctors into, whether it's a startup or an acquisition? All those numbers have been great. So our loan amounts have increased. So from access to capital, can we still do this? For sure. We had another record-breaking year for us last year, which is exciting. And all that tells me is, look, this is still the place to be in this industry. And we're pouring a lot of heart and soul and money into it as well, because we want to be involved. And there's a lot of really bright things on the horizon, which is great.
Yeah. And I just appreciate, I know I've had a relationship with Bank of America for, gosh, almost 19 years, going into 20 years, as I have owned my business and been working with startup practices. And there's always this adjustment period, right?
Yeah.
And we can both look backwards and say, wow, we were doing loans when we were topping out at 500,000 and thinking they'll never need that much money.
Yeah.
And now we're doing loans at 800 to $1 million and thinking, ooh, is that enough? And I always say it has nothing to do with the fact that the practices that we're doing or what the doctors are doing are anything different than we were doing loans at lower amounts. It has everything to do with just where our markets are at and just where things are at right now. And that kind of leads me into, as I've got a lot of our listeners that are younger docs, maybe still residents, early associates and whatnot. And I really would love it if you could maybe give some advice on maybe some smart financial steps as far as what they should be thinking about, what processes they need to be doing to prepare, maybe while they're still in school or early in their career and not quite ready maybe to do a practice that really helps them when they get in front of you as a banker to say, hey, can I get that 800,000? Can I get that million to start my practice?
For sure. Yeah. And these are great. These are great things to prepare for. It's not something that everybody necessarily loves talking through, but like those decisions that they make, taking out a credit card and going out every weekend and buying everything you want and having $15,000 on a credit card, like, that could truly impact your ability to borrow money down the line. Same thing, they come out of residency making really good money, or even sometimes in residency making really good money. Hey, that Tesla would be really cool to have, but look, $1,000, $1,200 car payment a month, like, that's going to come into play. We give $1 million to somebody right out of residency to go start a practice, but it's not everybody. The ones that have gone and spent or borrowed a whole bunch of money, those are the things that we have a tough time with. So the more you can set a little bit of money aside, be smart with the car you drive, the house that you want to buy. Everybody has student loans for the most, unless you're very fortunate, everybody has student loans. I approved a loan for somebody that had $900,000, which I'd never seen before. But ultimately, that doctor, they made the decision to borrow that money to go to school, and they were very conscious of everything else they were doing. So the rest of their financial picture, although that is a big number, it still worked. So that was a great example of, look, this is an outside the box. We don't see this every day. But they also had older cars that were paid off. They had a low mortgage payment, so that helped. But all of that from year one of college, when you want to have the status symbols, that's great. But just know that if this is in the future, all of those things matter, and we'll work with it. Everybody's got a little bit different background, but the more you can save and the less that you spend and borrow, certainly the better position you are to, whether it's to start a practice or buy a practice down the road.
Yeah, that's great. As you think about these doctors that are setting themselves up, you mentioned just a little bit about savings. I'm curious if you can give us any benchmarks. If a doc were to say, hey, I'm out, I'm working on my revolving debt, getting that paid down. I've secured a job where I've got a good contract in play and all of that. What does the savings look like if they were thinking, do I have to have any money in savings? If so, what does that look like if I want to do a startup practice?
Sure. So it's always a moving target for the most part. Sure. Yes, we do want to see something. So these loans are awesome. You're not going to have to put any money down, but we want to see that you have something set aside so that if you need it, the office shuts down. COVID was the most extreme example. You still need to pay a staff and pay your bills. So generally, especially for a startup, if a doctor's got somewhere between 40 and 50,000 that they've set aside, that would be awesome. There are plenty of cases where people have less than that because they've decided to go buy a car with cash or something. So as long as we understand the why behind it, what we don't want to see is, hey, I have $5,000 to my name. I have a bunch of credit card debt. We're not going to put somebody in a position to go also have $1 million loan with no backup at all. So I would say that 40 to 45 is a really good benchmark. Not having credit card debt, if you can avoid it, is also hugely helpful, hugely important. But we're not asking anybody to put any money down. We're not asking you to go have 100,000. there are also ways that we can get family to help. So it's just being smart with it and having a thoughtful way about it. And if it's not there and we can talk through where the money has gone or they've gone and paid down some debt, that's fine too. But as a bank, and this is banks in general, we don't necessarily need you to go pay down your student loans a whole bunch before you come and talk to us. Like, we understand there's going to be a monthly payment, and that's part of the gig of being able to be in this position. So we'd rather you save some of that cash up front and readjust if we need to.
Yeah, that's great. So let's talk a little bit about practices and doctors who are thinking about buying an existing practice, because I jokingly say this about lenders that you guys hand out $800 to $1 million in a startup loan like it's Halloween candy. You just have to ring the doorbell and say, "Can I have some money, please?" And you're like, "Sure, no problem."
Sometimes.
Yeah. But it's a very different picture when we're looking at existing practices.
Yep.
And when a doc is evaluating, well, this doctor wants to sell their practice for X amount, and we're looking at numbers, and there's other things that we're looking at. So I'm wondering if you can just break down for us, like, what you guys are looking at, those pros and cons from a banking perspective. And I just think there's so much more complexity to this. And it almost seems like it would be easier to get money for an existing, but it's actually not easier. And I love for you to talk us through that.
Sure. Yeah, I think, like, we talk about startups a lot, and look, we have these measurements and we're guessing. And there's projections that we're using. And so we're not using real data. And if you can fit within the amount of debt that you have and it works from an income perspective, awesome. When we're looking at buying a practice, we're looking at an actual set of financials where there's cash flow in this practice. The seller is making money. And so we are literally evaluating, if we take this seller out of the practice and we put you in as the new seller, can that practice support all of the debt and payments that you're making personally? Can it support the debt on buying the practice itself? And are you still going to live comfortably? Because we're not going to do a loan to go help somebody buy a practice if they're going to have to grind and scrape by. Now, does that happen? For sure. But we want to make sure that from a financial perspective, you're going to be set up for success. And unlike, you think about going and buying a house, there's not very many people that say, "Hey, you can't afford to buy this smaller house. You got to go buy a bigger house." In the practice space, for sure. So you think through, somebody that has a $2,000 a month mortgage payment can afford to go and buy a practice that doesn't have as much income for the doctor to be able to take home. But if I have a $10,000 mortgage payment that I have to pay every month, I need a practice that I can go in and it can support me right away. So the variables are significantly different because we're evaluating, hey, if this person leaves and you come in here, how comfortable are you going to be able to be? And can you support yourself and your family and everything else that you have going with it? So that's from the banking perspective. And then it's really the pros and cons are the flip of a startup, because you have income already coming in. You have a staff that's already hired. You can count on some of these things. But then the flip is, this isn't yours. You didn't pick the location. You didn't pick the philosophy of how this is run, which is where you and your team come in to help change some of that. But it's just a different mentality for sure. And it's not for everybody, but we certainly try. Those are tougher conversations to go tell somebody, like, "Hey, this practice can't support you." And it's not a bad thing. It's just very case by case. So it's tougher to tell you, yes, you can afford it, or no, you can't, until we really dive into, what that practice is doing.
Yeah. If we were to unpack that a little bit, are there any markers that you guys look for when you are evaluating a practice? Like, for instance, the amount of AR or percentage of delinquencies on accounts, or how much cash flow consistently the previous doctor has brought in. So just, if you wouldn't mind talking about that just a little bit.
Yeah.
So if a doc is thinking that way, they know some of those things that a bank would be looking at, because it's definitely not, I know this, not based on the doctor selling going, I just feel like I want 800,000 for this, because that feels like a good round number.
For sure. No. And there are plenty of them that try to do that. And we're not the valuators. Like, you and your team do that. CPAs do that. We are sometimes I use the term doom and gloom. Like, we want to see worst case scenario. Is this going to be a fit for you? I would say the markers across the board, it's more trend based. So has the practice over the last 2 or 3 years been consistently bringing in the same amount of collections, same amount of revenue, or similar? Has there been a spike up? What caused the spike? Is it because of something they did that's going to be sustainable? Was there a drop? And if there was a drop, is that going to be happening over time? Do we know what caused that? We look at everything. Every single time we evaluate a practice, we're looking at every single benchmark, whether it's revenue, it's rent, it's wages, compared to the industry averages for that specific region. So we get very specific of orthodontists on the East Coast. And if wages should be 31% and they're listed at 50%, what is that? And who are they paying? And again, is that something that you're going to take on? There are a lot of signs for a healthy practice versus an unhealthy practice. It's not cookie cutter across the board. I would say every single time we look at a new practice, which is weekly, there's something different that pops out. But at the end of the day, I care more, and I'm trying to help educate our doctors on, hey, I'm seeing these things change. This is out of whack. Like, this is higher or lower than what we see, but also these things are changing. And so when you're in there and you're evaluating the practice, ask these questions, make them, because there's a reason. There's always a reason. Sometimes it's my CPA told me to do this. And sometimes it's, hey, we were struggling and we put an extra $50,000 into marketing and this really worked for us. Great. Now our buyers know that's something they need to probably count on doing if they want to maintain that level of it.
Yeah.
And then really it just boils down to the income of the practice. That's really ultimately what determines, is this going to be a good fit financially or not? At the end of the day is, again, can the income support our new buyer from all avenues?
Yeah. And I think it's important to say this just because I know I see this on my side, especially on practice purchases that are smaller. A lot of times I do see where my docs, part of the condition of that practice purchases that they are holding another job outside of the practice that they're purchasing. And it almost sounds counterintuitive, right? Yeah, you get that on a startup because you're starting from zero and you've got to build up. You don't always think about that on a practice purchase, but I know, and maybe you can speak to that a little bit, that sometimes there are conditions or suggestions, I guess it depends on how it comes across, of, okay, if you really want, this is what you're going to have to be really thinking about, doing that extra work. And I know from a consulting side, a lot of times we'll get these practices and the doc says they're working 4 days a week, but they're seeing 15 patients a day. And we're like, heck, we can consolidate that down to 2 days a week. And you've got 3 other days a week to be working somewhere else until that practice is built up. Do you mind talking to that a little bit?
Yeah, because those are interesting opportunities, because like that's where you've got somebody that sort of sees the value of doing a startup because it's a practice that they're going to have to build, but there's still a patient base. Those are great opportunities. And those are our doctors that they come in and they're in a practice that's collecting $500,000 and you can build that to $1 million in a very short amount of time, which is awesome. The way the bank's evaluating it is, if that practice stays at $500,000 though, can that practice support you right now? And oftentimes, sometimes it can, oftentimes it's too small. And so then we do have to go the route of, hey, maybe you associate 1 or 2 days a week and you have that income that you're counting on. Sometimes we get away with it, like a spouse works. And so from a household perspective, we can use spousal income to help offset some of that because we know they're going to be helping pay mortgage payments or auto payments. So those are great opportunities. And I talk to doctors and like, it's so cheap. This is going to be such a great deal, which is usually very true. But big picture, again, worst case scenario, hey, here's how we're looking at this. Make sure that you can still support yourself while you make this into $1 million, $1.5 million practice, which generally can happen in a pretty quick turnaround.
Yeah. And I always am trying to encourage docs that it's just really interesting how a lot of times the banks will evaluate and say, hey, you can start from zero and we'll give you $1 million. But if you're going to start with some cash on your books, we're going to be really scrutinize that. But it's just the fact that there's a debt load that's there that has to be serviced, and it's just coming at it a little differently. And I guess the encouraging thing that I want any of our listeners to hear is that I think that it's really important that you never take everything as it has to fit into a certain box. Like you want to evaluate each opportunity that you have very independently. And I'm sure, Matt, you would agree with this. Sometimes that's just getting counsel from your banker to say, hey, this is an opportunity. What does the landscape look like if I were to invest in this opportunity versus a different opportunity or whatnot? And I feel one of the things that I've always loved about you guys is you're pretty good about being able to give a doctor a pretty good understanding of what they're going to expect before they get too far into the process to realize, oh my gosh, I just invested all of this and it was never going anywhere in the first place.
I think it goes back to the theme of pretty much every episode that you do. Like you have to have a team, regardless of who's on the team. And there are multiple mini teams that a doctor is going to have throughout the life of being a practice owner. But like that initial team of your team, the banking team, the CPA, whoever they're talking to, there's going to be good things you're going to hear. There's going to be bad things you're going to hear, but you want to surround yourself with those people that are going to set the right expectations. They're going to let you know, hey, here's how this is going to be evaluated. And so there aren't any surprises, but you've got to have people that you trust that are going to give you all ends of the spectrum on what that feedback and those responses are going to be so that we can help their journey be what it is and be a positive one, obviously, at the end of the day.
Yeah, for sure.
And now a word from the sponsors who make this podcast possible. Are you thinking about opening an orthodontic practice? I know, it's a big decision, but saving 25% on the ADEC equipment you need to get started, that's an easy one. Because ADEC has a special program called Smart Start, designed to help you launch your first practice. You get up to 25% off your ADEC orthodontic equipment and furniture. You also get complimentary services to help you run and grow your business. And my favorite part, access to the Smart Start pricing for 2 whole years after you open your doors. That gives you flexibility to add more chairs as your cash flow grows. It's pretty smart. As an orthodontist, you care about getting all the little details right, and ADEC really got it right with this program. So if starting off with a big savings on ADEC equipment sounds good to you, the ADEC Smart Start is definitely worth a closer look. Just follow the link in the show notes to learn more. Hey docs, let's talk about Smile Suite, because it's not just another scheduling system. It's a game changer in the world of new patient management. And as a proud Smile Suite partner, I've witnessed the incredible impact it has on practices of all sizes. Smile Suite means your new patient calls and web leads are expertly handled 7 days a week, even during nights and weekends. And they offer top-notch customizable presentation software and seamless post-consultation follow-up. It's like having a secret weapon for your practice's success. Curious? Dive into the revolution at getsmilesuite.com. And don't forget to mention Hey Docs to unlock some extra goodies. Elevate your practice with Smile Suite, because every smile deserves a suite of excellence.
So I want to switch back to startups again. And I do want to talk a little bit just about costs in general. And I know costs in what our startups have, from rent to construction, just in general, our budgets are so different than they were 6 years ago, 8 years ago, 10 years ago. And I'm wondering, I know you touched on this in the beginning, but if you can just maybe reassure docs or talk about how you guys have even just changed up your loan structure a little bit to make it like to understand the landscape of where things are at, and not just strap our docs into something where they're like, I can't even afford this, even if I wanted to do this.
For sure. Yeah. And like looking back when I started here 15 years ago, like startup amounts were 350,000. And for an orthodontist to go start a practice, it's $1 million for individual orthodontists to go start their own practice. So it's crazy. But to your point, we didn't just say, oh, construction's gone up, so we have to give out more money. Like these are very calculated things that we're a bank, we're evaluating risk every single day. And so based on the performance of our existing clients, it justifies it. One thing we haven't changed and that we do feel like sets our orthodontists up for success, even though they're borrowing up to $1 million, is a graduated payment structure. So unlike buying a practice where, hey, there's cash flow there and your payment's going to be due right away, on a startup, you're not making a full payment until that fourth year that you're in business. Now, not everybody needs that, but ultimately that's the runway that helps. That yes, it's a lot of money. Yes, you're borrowing a lot to make this thing what you want to make it and make it really great. But these are all things that we've calculated. And thankfully, the industry is awesome and it's thriving. And so it's justified the ability to increase it as construction's gone up and equipment's gone up and everything has increased in cost, but also performance has gone up as well, which is great to see. So we're going to continue to monitor that. And if it needs to increase in the future, great. But it's also something where, look, if you can go find a space that is going to work for you and go do it for $600,000, awesome. Like more power to you. That's why you surround yourself with the right to be able to do that. Yeah. Very encouraging across the board, just with kind of the trends and what's happening with performance as a practice everywhere.
Yeah. And I think that has been one of the things that I have really appreciated about Bank of America is that super flexible up to the 4-year runway of those interest-only payments and whatnot. Because for anybody who's heard me speak before, I am always saying we are cash poor in those first 2 to 3 years. And we're starting to make momentum and making good strides after year 3 if everything is trending the way it should. But the more breathing room we can have without those really high payments in the time while we are building our business and building our brand and getting our systems in place. Year 5, I'm not worried about my docs. They're bringing home income. They're doing well and they can hit a full payment. No problem. And maybe even sometimes have extra to put towards equity or whatnot, but our principal, I'm sorry. But in the beginning, I think having the flexibility to have something that fits a little bit better really makes a big difference.
Yeah. And just to give you an idea, like the startup loan is still, it's more risky than an acquisition because there's more variables associated with it and everything else. But the performance in general is, the default rate is so low. The performance is so high. Like, again, we have our own way of looking at it, but we do these things for a very specific reason. And that's to make sure that our doctors are set up for success. And look, if you want to start making full payments because you're crushing it in year 2, nothing's stopping you from doing it. That's awesome. But if you want to reinvest that into marketing and continue to build what you need to, you have the option there too. So that's why we make it as flexible as possible, because we know they're going to be successful and it's about doing it your own way.
Yeah. In the event that somebody who's listening doesn't quite, I know you and I speak this because we live and breathe this all day long. I have got to imagine, because I hear it and I see it in the Facebook groups where a lot of times our younger docs are just slammed by docs that have started 3 years ago, 5 years ago, 10 years ago, and they hear you're taking out an $800,000 loan. That's ridiculous. You should never have to do that much. You're taking out $1 million loan to do a startup. I'm wondering if you can just talk about the buckets. When we think about where is $1 million or 800,000 going towards, I don't need necessarily specifics and numbers, but if you can just help break that down, because I think that there's a big misconception that all these young docs out here that are listening are just taking it in the shorts and everybody's raking them over the coals, when that is not at all what's happening. You guys wouldn't have, as banks, you guys do a lot of investigation into where to set these benchmarks too. But can you talk to that a little bit, just for somebody who may not understand actually how that money, you're expecting that money is going to be spent as a bank?
Yeah. And again, like to those doctors that are saying that, this is all based on performance. So we're not just making up numbers and saying, hey, we're going to give you all this money. So there is a really good reason behind it, but there's a lot of things that go into it. So construction eats up the bulk, in most cases, and I'm just speaking in general, the bulk of that budget, because you figure a 2,000 to 2,500 square foot space is going to cost $500,000 to $600,000 to $700,000 to build out at times. Equipment's probably the next biggest, where It's at least 2 to 300,000 at times, depending on the space. And a lot of times construction is dictating how much we have to spend there. But between those two, there's technology, there's marketing, there's hiring the right consultant to make sure that you're set up for success. There's so many things that go into all of this and making sure that the practice is going to be functional. And in today's day and age, the costs are just higher than they were. You couldn't start a practice unless it's an existing office that already had an orthodontist in there. You couldn't start an office for $350,000 like you could 15 years ago. But we're monitoring that. And we're not just handing $1 million check out. We, the bank, are helping make sure we're making the disbursements. We're sending the money out. We're not just giving them a blank check and say, hey, go for it. Good luck. Let us know how it goes. We're monitoring and making sure that we're the backstop of, hey, is this right? Is this invoice accurate? So they're not just making payments for no reason.
Right.
I mean, all of this is very calculated, and it's just expensive to do it these days.
Yeah, it is. And I think that I appreciate you talking about those buckets, because even to the point of working capital, we could easily get away years ago at 50,000 in working capital. No problem. Then it crept up to 75. And now I'm telling docs, like, I'd like to see between 75 and 100 in working capital. Yeah. And again, when you think about that loan, it's everything. I look at it from a consultant standpoint. That is everything that it's going to take to get us to doors open. And then what is it going to take to keep you safe for that year and a half after doors open? You usually are still going to need to keep an associateship job. I always tell my docs, your personal life needs to be paid for by that associateship job or spouse or anybody else, because you are going to be cash poor in that practice for a good couple years. It will catch up, it will cash flow, but you've got to have that runway. And that is why we take out these loans. And it's also why a lot of times, and maybe you can speak to this too, I'm always cautious when I hear docs say, I'm going to spend a lot of this out of savings and just drain out my savings and not take it in a loan because I don't want that big of a loan. And maybe I'm opening up a can of worms here, but I'm always a little bit like, maybe let's talk about that, because that risk is under that loan and that's spread out over a longer period of time. Yeah. And when you start cash flowing, maybe you can do something else with your money versus dumping it all into this where the return may not be there. I know I'm getting in a rabbit hole there, but I wonder if you have any thoughts on that a little bit, because I hear docs all the time that say that.
I know. And it's one of those things where it's such an easy thing. One, it's not that it's easy to borrow money, but it's like we make it fairly easy to go and borrow money for what you need to open your office. At any point when you're spending somebody else's money and things are going well and you feel like you have that safety net of, hey, I'm comfortable, I'm bringing money in, you can make payments. You can make bigger payments on that loan and reduce the principal. So you could make $100,000 payment and reduce it to what it would have been, but I don't know. This is the type of person I am personally too, like not having something there when there's just so many unknowns and so many things that can come up. And who knows what's going to happen. Things come up with the office 5 months in, 2 years in, and using everything you have when it's harder. And this is a fact. Like, it is easier to borrow money, to your point earlier, before you have any true, real business. It's harder to borrow money once you have actual clients coming in the door, because we're going from using projections to using what you're actually doing. So borrowing money while you can, while it's there, and pay that thing down once you feel comfortable and you feel like there's less risk to you. That's always my advice. Again, I'm a more conservative person anyway, so I would rather have a little bit of a safety net. But there are people that are very much interest averse and everything else that would rather not see it. I just think it's so important to have a little bit extra there and use us while you can until you don't need us anymore, really.
Yeah. Yeah, that's great. And I know I took us in a rabbit trail there, but very similar perspectives as you do, and feel like, gosh, there's so many other things you could do with that money. And I'd rather you get past the 3-year mark, especially if you're doing a startup, and then worry about all the money you have and what you're going to do with it.
Yeah, exactly. It's a great problem to have.
It's a great problem to have. Yeah. So as we finish up here, and I think you've done a great job at helping us talk about acquisitions and startups, is there anything that you think we have not covered that a doctor would need to know or understand in the differences of a startup loan versus an acquisition or loan, and how they may approach it differently, or anything that we didn't cover? Because I felt like we did a pretty good job.
No, we covered most of it. I do really feel like it's a mindset. Like when I talk to people that are like, I don't know which route, they start touring spaces and seeing an empty box. And if they get excited, hey, startups probably for them. Like they see that, they see the vision, and they see the grind ahead. Not that there's not a grind with an acquisition, it's just a different grind. But if somebody goes there on the flip side and it's, wow, this is a lot more than I thought, those people usually shift to, hey, let's go find a practice. But it's really like the financial piece of it, again, I can't stress enough, and we talk about it all the time. Find your people that can help set you up for those things early before you know what you want to do, so that when the time is right, like you're ready for it. Even if you don't exactly know the direction you want to go, at least financially, you're ready for it. But build the team. You can build the team when you're still in dental school. And then when you go into residency, have a stronger team, have a mentor. Just do as much as you can. And there's not enough business acumen, unfortunately, that they learn in school. So the more that you can do to read, listen to podcasts like this, where you're just getting information, learn how to read books about hiring people and leadership. That's not really a bank thing. This is not my area of expertise on that, but I truly am like super passionate about the more you can do to prepare yourself to be an owner from everything else. And then once you're ready, teams in place to help you find the right fit, whether it's a startup or an acquisition.
Yeah, that's great. That's great. If somebody wants to connect with you, if they're like, all right, I think I'm ready, I got some questions, I've been weighing this, weighing that, what is going to be the best way, Matt, that they can reach out and get in touch with you?
Yeah, so they can always connect through you, and you can connect them to me.
Yep.
You can always call or text. My cell phone is 720-338-1165, or you can email me at matthew.kroeker@bofa.com, bofa.com.
Yeah, that's great. You are always such a great resource to myself and to my doctors. And I really appreciate, again, what you do in the space and where Bank of America has been. It's definitely, you guys are the ones that are moving us forward with all of these new startups out there and pushing our industry forward. So thank you for that.
No, thank you.
You know how I like to finish this? I like to finish us with a little speed round. Are you ready for a little speed round challenge?
Let's go. Let's do it. I love it.
All right, here we go. What is your go-to strategy for getting unstuck when you are facing a tough problem?
I am a face it head on. Stop contemplating, stop complaining about it. Just go call whoever it is and just figure it out. Let's just do it.
Yeah, I love that. I love that. What is one piece of advice you wish you had followed earlier in your career?
I wish I had read more. I'm starting to read more. The older I get, the more I read. I wish I had read more all across the board. It doesn't matter, but just more learning and education, I think, is awesome.
Yeah, that's great. And then the last one, if you could add one unconditional perk to a workplace, what would that be?
I am a pacer when I'm on the phone. And so the noise canceling on the AirPods has been a godsend for me, because I always have a ball. But like having a mini hoop in every office I'm ever in, I would love that, because it gives me something to do while I'm talking to people on the phone all day long.
I love that. I would never, ever hit the hoop if I had that. So if you put that in
it's just something
space,
to do.
Yeah. I'd be like, I missed again. That's great, though. Thanks again, Matt, for being on the show and for, again, giving us such good information. And I look forward to having you on again. Thank you.
Yeah, thank you so much. This was awesome.